even though we know a lot of the factors which have pushed up the inflation rate in New Zealand are temporary, related to supply chain disruptions overseas, that is definitely not the case for all of the things out there. Well, hello again, everybody. Sometimes it's difficult to know where to start when you're looking at some things happening in the New Zealand economy, but hopefully by now you've seen what's happened with the inflation rate. If you go back about 5 months ago, maybe 6 months ago, when the Reserve Bank released their May monetary policy statement, they predicted that right now, as we sit today, New Zealand's inflation rate would still be around about 2.5, 2.6%. In fact, we're sitting with inflation now having just increased from 3.3% to 4.9%. Now, the Reserve Bank recently, 2 or 3 weeks ago, had said they expect the inflation rate is going to go above 4%, but they definitely would not have expected 4.9%. And this basically is a bit of a problem now for our central bank. Inflation is running well above anything they have reasonably expected over the entirety of this year. They are responsible for keeping inflation between 1 to 3% on average. And already out there in the media, and I guess social media as well, we've got some people saying maybe the mandate for the Reserve Bank will get changed. Maybe they'll be told they should target higher inflation. We are starting to enter relatively dangerous territory now, and especially because even though we know a lot of the factors which have pushed up the inflation rate in New Zealand are temporary, related to supply chain disruptions overseas, that is definitely not the case for all of the things out there. And when the Reserve Bank targets inflation, they are allowed to look through sudden shocks and see what happens afterwards. Well, of course, we are seeing those shocks, pass through the system at the moment, but the labour market is exceptionally tight, and essentially if your wages have not gone up by 4.9% over the past year, you are poorer now than you were 12 months ago. Wage growth is starting to pick up, and I would suggest it's going to become relatively strong over the next 2 to 3 years, with a 4% unemployment rate and businesses simply not able to find the staff that they want. Now, the Reserve Bank is going to look at accelerating wages growth and go, that seems a little bit dangerous, but will that lead to businesses increasing their selling prices? Well, yes, they will. A, they already have. B, they're going to do more, because traditionally, when you and I would see the price of a business's output go up, we would go online. We'd find something cheaper. We could probably still do that today, but we're not going to receive it maybe within the next 6 months or so, as I think I might have mentioned in a previous video there. It all adds up to there's a danger of a wage price spiral out there. Not a high probability, but it's definitely moving in that direction. The Reserve Bank's credibility is being called into question here, and at some point, they're going to bring down the hammer with interest rates rising quite rapidly. Now, for the moment, they're still concerned about COVID, as we all are, lockdown disruption on the economy, but really you need to be aware that there is going to be an interest rate increase catch-up period at some stage. The wholesale interest rates, which banks borrow at to lend to you fixed, have already gone up quite a bit over the past 6 months, and they've gone up quite a bit more this week, obviously with surprisingly high inflation. If you haven't got yourself fixed maybe at a 2, 3, 4, or my preference there for a long time, 5-year fixed mortgage rate, you're going to start to find possibly the interest rates moving against you. And I stick with my view that the 1-year fixed mortgage rate, we're going to be seeing 5%, maybe in 18, 24 months time. So all I can say is you've sort of been warned there. Interest rates are going up. You've had a period of unusually low rates. Now there is catch up to be done by our central bank. It's going to be an interesting ride for the next 2 to 4 years.